the tax brackets have changed slightly from 2017, when the max tax bracket for individuals was about 39.6, and now it's a maximum of 37%. And those tax brackets that you see here in the chart reflect the same rates that are implemented throughout from the TCJA Act period from 2018 through 2025. Now, after that, those tax rates expire, and what comes up next is unknown. But this is the way it'll be. The only adjustments that they make in terms of the tax rates would be for inflation adjustments. So the rates, the brackets themselves, even though the tax rates stay the same, the brackets will be inflated for inflation. So that's all you really should know about the brackets. Now, the standard deduction. Standard deduction is increased this year to $12,200 for single, or $24,400 for married filing joint. The tax brackets were increased from previous to the TCJA Act with the intent to simplify the tax laws. And as a result, conceptually, more and more people will use a standard deduction rather than itemized deductions. Not that itemized deductions are not still implemented, but it's a lot less, more likely that your standard deduction will give you as good, if not better, benefit. Standard deduction also for head of household, $18,350. And again, these are going to be adjusted for inflation. Exemptions. The personal dependent exemptions used to be $4,150 in 2017, but now they've been repealed throughout the TCJA period. Therefore, you don't need to spend your time to allocate the benefits of the dependents between spouses. There are additional reasons, though, for maintaining who has these dependency exemptions, to which Art will address in Dissomaster. The child tax credit. Well, the child tax credit is a credit against your tax. It is $2,000, and it's a non-refundable credit of $500 for dependents that are not qualifying children. So if you have qualifying children, your child tax credit would be the $2,000 number. It does phase out. There's a phase-out period depending upon your income, and $400,000 for married filing joint versus $200,000 married filing separate. And now the refundable credit, it's a refundable credit up to $1,400. Itemized deductions, let's talk about those. All right, what's still around? Medical and dental. Now, medical and dental, there's a deduction to the extent that it exceeds 10% of your AGI. Previously, it was 7.5%, I believe. So what you can see is that they're trying to reduce the impact and the significance of itemized deductions on your returns. Also, the deduction would be state and local taxes, or so-called SALT taxes. Those are limited now to $10,000 through 2025. Again, the purpose was to minimize the impact of significant itemized deductions. Charitable contributions. Previously, you were able to deduct charitable contributions up to 50% of your AGI, and now it's able to deduct up to 60% of AGI. Usually, from my past experience, I'm not seeing too many taxpayers who are at that rate, at that level, that they would contribute that much of their income. So it may not have a significant impact to most of our cases. By the way, it used to be that if you purchase tickets to an athletic event, you would make it a deduction, but now that's a bye-bye. You can't get that any longer. Mortgage interest. Mortgage interest is now, the deduction is limited to $750,000 of acquisition indebtedness, with no deduction allowed for interest on home equity indebtedness. Used to be where you were able to get a deduction if you took out a home equity loan. But now, unless that loan is used for acquisition or improvements to property, you're not going to receive a deduction for it. There's an exception with respect to the limitation on mortgages that were acquired prior to October 13th, 1987, and that's over 30 years, guys. The loan was grandfathered in, and that you can still deduct 100% of the interest without the limitation of the $750,000. Now, between October 13th, 1987 and December 15th, 2017, that limitation on the allowable debt was $1 million. But now that has decreased for after December 2017 to $750,000.
So, and half that for MFS.
And half that for MFS.
Yeah.
Okay. Married filing separate. Oh, half of the limitation of 750 would be available for married filing separate. Okay.
And the cutoff date was December 15th. So December 15th and earlier would qualify at the million, and 16th and later. But there are some exceptions that you can get into if you have that case.
Yeah. You'd probably want to see a tax person for that. Miscellaneous deductions. Previously, you had these miscellaneous itemized deductions that were deductible to the extent that they exceed 2% of your AGI. Now, all such deductions are suspended during the TCJA period. So it used to be you had your clients run into you saying, well, how much of your fees can I deduct? How much of the accountant fees can I deduct? Because they needed it for their taxes. Now you don't have to worry about that. You can tell them, sorry, but the standard deduction is probably the better way to go. Casualty and theft. Previously, the losses we were able to deduct to the extent that they exceeded 10% of your AGI. But now the deduction, again, has been suspended. And if you see a pattern here, it's because, again, they want to simplify, or at least according to them, simplify the tax returns by limiting the deduction, however, giving to you the standard deduction increase. So that's their attempt. After 2025, though, don't know what's going to take place. So these are adjustments that are going to be taking place just over this TCJA period. Sale of a principal residence. Well, that's still available to exclude the gain on the sale of the residence which is $500,000 for married individuals, or one half of that amount, or $250,000 for a single person. And again, the requirements within the qualification for exclusion was a 2 out of 5 years of residency. That hasn't changed.